Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, we're going to be looking at the US stock market today using our proxy for the S&P 500, which is the SPY ETF. We're also going to look at the put to call ratio, the PCC and the VIX. Right then, without further ado, let's not waste any time. We're going to start with our Elliott wave counts, get straight into it. So the rally continues, the rally that I've been bullish on since coming off of the 2022 lows, and once we cleared that February 23 high, I was fully committed. And I'm not the only one, a lot of people have participated in this thing, but my own experience is that this has been one of the more hated rallies that I've been a part of, in terms of the bears just being completely relentless in their bearishness and their viewpoints. I've been here before. They were around during COVID, coming off of the lows. They were around coming off of the power pivot in 2018. They were around coming off of the lows when Trump was elected in 2016. Why am I saying this? Well, there's an old saying which is the market climbs a wall of worry. That's what bull markets do. My point is, the worry is always there. The bears are always there. The negativity is always there. If you're waiting around for the perfect set of sentiments to show up, by the time the perfect sentiment shows up, it's probably the top. Okay, so don't listen, would be my advice. If you're going to talk yourself into it, or if you're going to talk yourself into anything, you should talk yourself into it, not out of it, if you understand my meaning. But either way, what does this mean? Does Tom think that the market's just going to go vertical from here forever and it's never going to pull back again? Of course not. This massive bull market, which has gone on for over 100 years and will continue to go on, we can see when we look back throughout the entire history of the S&P 500 and the Dow before it, that this is what the market does. It climbs a wall of worry, but it is periodically upset by some pretty severe pullbacks along the way. Things that Elliottians would call wave degrees or wave corrections at various degrees, wave 2s and wave 4s, right? And we will continue to experience these things going forward in time. There will be pullbacks, but these pullbacks are buying opportunities. The day may come when all of that is over, but there's no point calling an end to the party while the lights are still on and everyone's still screaming and dancing and throwing themselves around on the dance floor. The party is still in full swing. We're at all-time highs. That's obvious to anyone who's watching. Now, that doesn't mean, like I said, that there can't be pullbacks along the way. So, on that note, let's start with the bullish count. I'm just going to turn this pitchfork off. So why have I got so many invalidation points? Well, because we keep getting shorter and shorter corrections and smaller corrections, right, as we continue higher. We do have an alternate count where we could be topping out. We'll talk about that in a minute, so just keep your hair on. But in the meantime, we have got 1, 2, 1, 2, 1, 2 for days. Intermediate degree, minor degree, minute degree, minuet degree, sub-minuet degree, micro degree, and now looking probably for sub-micro degree 1 to come in. And to come back, we've got a gap beneath us. We've gapped up very strongly, and we may fill that gap, we may not. Sometimes we come back and fill them, and sometimes we don't. You know, we've got a gap back here which we didn't even touch the territory of. We've got gaps all the way back here to November 23 which we haven't filled. A day may come when we have to, and we have a calamitous crash, but for the meantime we are not doing that. So I'm just going to put in another label and suspect that another 1 is coming in. A 2 will come in after that. There'll be another pullback. But the reason we're keeping this so simple, let's just come down to the 2 hour, is we've got micro, sub-minuet and minuet wave degree level wave 2 completions beneath us at 567 spot 89, 539 spot 44, 510 spot 29, and we want to see if price comes back through these levels and stops this continuous uptrend of higher highs and higher lows which we're still in. And the local trend that we're in will break at 567 spot 89. Confirmation of a larger trend completion or a larger wave completion will occur if we break the invalidation point at 539 spot 44, and if we swing below 510.29 or 493 spot 85, we've broken a much longer upward trend. So there's a long way between us and that happening though, so we're just continuing higher for the meantime, but we've got our points to look forward to. So if the market were to pivot and start breaking these levels, we can change our outlook and we can adopt an alternate count instead. So on that note, what could an alternate count be? Well, Here's one which has the market topping out pretty much now. We have wave 1 and wave 2 back here with the highs of December 22 into the lows of March 23. We then have 5 waves up at minor degree into intermediate 3, into a sharp correction for intermediate 4. And then we have an ending diagonal. 1, 2, 3, 4, 5. 4 is shallower than 2, 3 is shorter than 1, and 5 is shorter than 3. I know those are not the up-to-date rules for diags, but they are my preferred interpretation of such. And we are here currently with an invalidation for the diag because the wave 5 has to be shorter than the wave 3. That is a strict rule, even in the latest edition of Elliott wave. So we can't go beyond 614.99. So we have invalidation points above and invalidation points below, right? The current bullish primary count ceases to be correct in the short term at 567.89 and ceases to be correct at larger wave degrees at 539.44. If we were, however, in the alternate count to continue above 614.99, that actually adds more weight to the primary count, and we are going up into a wave 3 here, looking for higher and higher targets breaking out. So there we go. We need to be keeping our eyes open as always. Whenever we get through new all-time highs, we need to be keeping our eyes and ears open and paying attention. And we want to see if we get a pivot up here at some point, and we want to see if there's evidence in the following days and weeks of the market having topped out. But while the trend is heading higher, the trend is your friend, and we don't call an end to it until it's over. Okay, both are true at the same time. All right, they have to be. Now that's the two counts essentially. Then there is an alternate bullish count which basically moves the wave degree I'm working with down 1. So essentially we move the intermediate wave degree from here. Let me just show you quickly so I don't confuse you. In the primary count, the intermediate wave degree is back here, which is the winter of 2022 into the early spring of 2023. But in the alternate bullish count, we move that pivot higher with the base channel here, so that the wave 1 completes in July 23 and ends in November 23. So it shifts the intermediate wave degree 1 into 2 from the left here further to the right, therefore pushing the wave 3 targets out higher and further away. But it's very similar. It's very, very similar, and I had to pick one, so I picked this one. Okay. So let's just add that into the primary count. And save. There we go. And let's turn these gaps off. Right, so is there a bearish count? Well, not really. The old bear count I had, which was always I was not a fan of, has now gone so far beyond the pale I don't believe it possible anymore. This is the idea that the move down from the January 22 high was an A and the move back up was a B wave, right? Well, we've gone past a 1618 extension for a B wave, and as I wrote many months ago when I was preparing for this, if you can go back and find a video, probability greatly reduced beyond this point. So this is extremely unlikely now for this to be a B wave having gone beyond this point. Because it would bring the 1618 extension target for the wave C within the completion of wave A, which is extremely unlikely for what would have to be a running flat pattern with a B wave gone beyond the pale. So I figure now that the best way of looking at a potential bearish count would be to look at the completion of 5 waves from the low, rather than this being A and B. We have to say that the primary count is wrong and it's not an extended wave 3, but we are going to top out up here. This is what the alternate count provides. 1, 2, 3, 4, 5. We top out here and we just complete something bigger, and then we get a big bearish correction. Okay? And I think that's really the best opportunity for the bulls in the long term, but the best opportunity the bears have of being right. But like I said, we're in an upward trend of higher highs and higher lows, and we don't call an end to it until we see evidence of such occurring. So there's your counts. Just to recap quickly: primary extension, we continue to set smaller corrections and aggressively move higher in a series of 1s and 2s at smaller wave degrees. Alternate count, we have 5 waves up, we are finishing in an ending diagonal, we're approaching the top of the channel, and then we're going to roll over soon with the cut-off target at 614.99. If we go beyond that, this supports the primary bullish count and cancels this out as possible, because the ending dyad can't break that rule. And that's it. There's the two counts. There's not bothered with the bullish alternative because it's basically the same idea again. The bearish idea of a flat, I think, is out the window now. So let's now do some classical analysis before we come over and have a look at the PCC and the VIX. So some of the things I just want to talk about here. Now, you mustn't neglect this section. I know some of you turn off. You just get your Elliott wave counter and you don't listen to this stuff. But this is the stuff which tends to give you a warning of whether you're right or wrong. Tends to give you a hint of whether you're right or wrong. So let's come out to the daily time frame first. Switch off all of the count. Oh, is that the channels folder? Yep. And start with our moving averages. So on the daily time frame, we have the 10, the 20, 60 and the 250 exponential moving averages all pointing up, and price is currently above all of them. Nice bullish momentum continuing higher. We're a long way from a 250. Eventually we will likely correct back to it at a larger weight degree completion when that comes. If we look at the weekly time frame, the same will happen to the 60. We will come back, which represents the 250 on the daily time frame, or we'll get an even bigger correction, as we did back here in 2022, as we did back here in COVID, as we did back here in 2018, and we will head for the 250 exponential weekly average, which would be a very severe correction, as you can see. Now, if we come out to the daily time frame and bring up our indicators for a minute, alright, we can see that on the daily time frame, over the longer term, even though we keep swinging below the zero bound, we've had this gradual decline in momentum, right, where we've set lower highs in the MACD continually over time. We've done something similar since the recent high in the RSI, but I would be careful calling that, because we've come back to zero and essentially reset the RSI, as this is a new rally. This rally here is separate from this here, so we'd have to look for bearish divergence on longer time frames, such as the weekly or the monthly, for that to flesh out. Because what we've actually seen during this rally of higher highs and higher lows is we've actually seen the strength supported. We've seen higher highs confirmed with each high. Each high on the RSI coincides with each high in price. So over the shorter term, this rally has actually been supported by the relative strength. On the OBV, we were trading into this narrowing rising wedge. Okay, now the rising wedge in the unbalanced volume here doesn't have to confirm any sort of Elliott wave structure. It often won't, but it will often range in its own way, either sideways or within patterns like this of rising trends and declining trends. And this looks like a narrowing pattern where we've broken out the bottom and now broken out the top. So, well, it's interesting to see if we get rejection here, and if the OBV suddenly starts breaking down, then we can start looking through these lows to break. Right, all of these lows that we've set, which have supported price, the unbalanced volume, cumulatively has been bullish this whole time, as we set higher highs and higher lows. So if we were to pivot here and start taking out these lows, that would be a very bearish sign. Not very bearish that we're going to collapse or something, but bearish that we're into a correction, that we're about to have a pullback of something worth noting. Right, now if we come out to the weekly time frame, we can see a slightly different story. We can see much more significant bearish divergence, double bearish divergence between highs on the weekly RSI and lower highs on the weekly RSI, and then we've had highs and higher highs in price. Overall, the histogram has been declining, and we can see that the bearish div in the MACD, we've got the same thing again. So we'd have to shift this to here now, but we've got double bearish divergence here as well. But we've got to be careful, because we can move this to here as well, but we can see that the histogram here on the weekly is stronger than both of these prior highs here, still well below the momentum we had back here though. So there is bearish divergence on the weekly time frame, but it can disappear. Now remember, divergence is not confirmation as bearish or bullish divergence until we have a pivot in place. This is just divergence between prior highs and the current price, right? Unless that current price turns into a pivot and then we move lower, so we get a clear signal, a candlestick pattern pointing out a long wick to the upside, an abandoned baby, a shooting star, a bearish engulfing candle, a break of the current trend of higher highs and higher lows, right? A clear shift in momentum into bearish momentum, a breakdown from highs in the RSI. All of these things combined with Elliott wave to tell us that that's a pivot, that's a high, that's done. We now need to go into correction. Once that's in place, our bearish divergence is confirmed, right? But at the moment, it's just a warning. It's just saying we're weakening into these highs. Over the longer term, we're getting weaker rather than stronger. But if the average and the signal lines swing back up and take out these highs in the RSI and the MACD, then this is full-on bullish, because the opportunity to correct came and went and we didn't. Alright, so that would be very bullish if we were to start forcing higher highs in momentum and relative strength. Now on the OBV, we can see that long-term weekly time frame, we're at all-time highs here in the OBV, and we continue to push higher in higher highs and higher lows with no sign of slowing down. So very bullish picture on the OBV, bearish contradicting picture on the RSI and the MACD, price failing to confirm either way with a pivot yet, so we have to wait and see. So I would say the classical analysis at the moment is just telling you to be on your guard. Just pay attention. These smaller wave degrees are synonymous with weaker activity in their wave 2s because they are shorter in duration and in correction than these big broad waves that we've seen where we reach big highs in the MACD and the RSI. So it could just be an extension building up, slowing down, slacking off for a little while before rocketing higher, but it could be weakness. It could be weakness at a larger degree. So just pay attention, essentially, and wait to see if the market pivots. In the meantime, though, the trend is your friend. You see, like, you can prepare for an outcome, but that doesn't mean it's guaranteed. Okay, but you know. Anyway, I digress. I don't want to go waffling on too much. Another couple of things I want to consider, and a few more clues. So, switch off the moving averages for a moment. And we're going to bring up a good old-fashioned simple regression channel. So a regression channel, the red line represents the mean and the blue lines represent two standard deviations from the mean. So if you know your standard distribution pattern, which, you know, essentially a standard distribution looks a little bit like this on a graph, where you'll have your mean, and then you'll have your two standard deviations, right, like so, and then basically 98% of all results will fall within two standard deviations of the mean. Very, 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 very rough chart, admittedly, total disaster of a chart really I just drew, but you get the idea. You've got essentially that famous curve where you've got thin tails, fat middle, and the vast majority of results will fall within two standard deviations of the mean, of the middle number. Okay, so you'll get that, and this is what this represents here. So we've got all of the data from where we start the channel to where the current price is, and we take all of the data, and we can see that all of that data, vast majority of the time, falls within two standard deviations of the mean. There are exceptions. For example, if we do break through this barrier, it's often an example of a low coming in or a high coming in, because we are getting very far away from what's normal. We're not through the top yet, we're near the top. Okay, daily time frame, let's bring it back in. You can see that we're getting up, we've come back to test the median line here, and we're heading back up, and we're getting close to the edge. So we could be getting close to a correction. It's not a guarantee of one, but we often do correct when we get near the top of these things. Now if we look at some Elliott channels for a moment, let's bring up our base channel. So here's the base channel. Right. So rather than it being a corrective channel, we can see how as we've moved higher, we've broken this base channel and we've back tested it. We could also account for the alternative bullish count, which takes this high to this low as the first swing, and this is a sustained single wave. This was the alternative count here, and you can see that we've also broken this channel and back tested it and moved away. This points traditionally in Elliott wave to a wave 1 and 2 completing, and then a wave 3 and 4 completing, and then moving away. Now it could be 1s and 2s as well. That is also very common within an extension, that the smaller wave 1s and 2s will test the base channel before moving away and rocketing higher. We can't get an Elliott channel placed for our primary count because we don't know where the wave 3 at intermediate degree is, or the wave 4 yet, as we suspect they haven't occurred. We can place it in our alternate count because we suspect that the wave 4 has occurred, so we can go 2 to the 4, projected from the 3 to find the 5. This is Elliott's second method of placing the channel, and it's the final method of placing the channel once the wave 4 is complete. Prior to that, you take the wave 1 and the 3 to project the 5, projected from the 2 for the bottom of the channel. I hope that makes sense. If not, go read the book. Either way, what this tells me is that we are, just as we have been this whole time, we are pushing things a little far. We're stretching on that rubber band a bit too much. Right, so yes, we could still explode higher and we could get rid of that divergence, and it could absolutely go rocketing from here. That does happen and has happened, but also when we approach these conditions, it's also possible that the market tops out. So we've just got to be paying attention. So I think I'm repeating myself now, guys, so I'm going to call it there and just say, given what we've seen with our regression channel, given what we've seen with our own channels, given what we've seen with our alternate and primary count, and what we've seen with our RSI and MACD conditions and OBV conditions over the daily and weekly time frames, suggests that we could be pushing things a bit too much, pulling on that elastic band a little bit too much. So that's enough on the SPY. Let's come over and have a look at the PCC. So I've got here all of the high chart line readings and intraday extreme readings marked with yellow lines here to show us the extremes of our moving averages of the 60 and the 250 day exponential moving averages, which smooth out all of this noise. Okay, and that's what we're just trying to do, smooth it out over time so we've got something we can actually observe and pay attention to. And then I wrap around those two moving averages these lines: extreme complacency / bullish, extreme fear / bearishness. And it's rough. It's a rough guideline. It's my own invention and it's a very rough guideline. But generally, the extreme bearishness and fear line tends to be respected by the 60 exponential moving average or just peaked above it occasionally. We could always adjust it if market conditions change over the long term. But once we've reached this extreme condition, and the 60 has stayed above the 250 for a considerable amount of time, eventually it moves back below the 250 and it starts to trend lower and lower. Now, it may be a more gradual trend like this one over time, or like this one over here. Okay, but occasionally it's a bit of a whipsawing thing like this was here. But essentially, over the longer term, we get a high and then we come all the way back from extreme bearishness to extreme bullishness, right? Maybe not all the way back, but a lot of the time we do. So we put in our highs here, so we are now in the process of coming all the way back to extreme bullishness. Right, we may whipsaw a bit, but that's what I think we're doing over the longer term. This supports the idea that the market's going to continue to push higher. There will be corrections along the way, but overall, while this trend is continuing lower, it suggests that the market's going to continue higher. Okay, now let's come across to the VIX. So here's my VIX chart, and what I've got here are a bunch of numbers which represent the significant events which have affected volatility within the market. So we have here the king of all of it, which is the global financial crisis, the GFC, which was, we got up to 96.4. COVID came in a close second with 85.47. There's COVID. We have these black swans, these events. Then you've got what I call the panic line, which is essentially 50. Right? We often come up to this or just through it. Okay, but when we do go through it and sustain a move above it, we panic. We get a panic event, and therefore this is kind of the line in the sand when people really start to lose their shit. And we had it recently, but for like a day. And I mean literally like a day. It wasn't a sustained move up like we saw during COVID or we saw during the GFC. Right, it was like a few hours we were up here for. This is not a line on the chart. This is a wick of a candle. Believe it or not, all of this is the wick of a candle. We came up to 65.73, and I can't think of a better name really for this, so I've just called it 2024 recession fear. It wasn't a COVID, it wasn't a GFC. It was just the data we were receiving on the macro at the time, everything from the ISM manufacturing data report on business through to unemployment levels, through to CPI, PPI. It was all pointing towards a genuine recession fear, and then it all went away in a heartbeat, and the market just carried on higher. Volatility disappeared. The PCC put in a new extreme as well, and I marked the extremes on here with the green lines as I do with the yellows on the PCC, and then I mark those on the SPY, and they invariably mark lows. They invariably tend to mark lows. So if we take the 5th of August 2024 here, for example, let's find the 5th of August 2024. Where are we? There it is. So we had our extreme VIX event, and here's our extreme bull event. 5th of August 2024 on the SPY. It was a low, and it was a low supported by a big stick of bullish volume. So what am I reiterating it? Why am I talking about that? Well, I'm just pointing out that I know it's another old saying, time in the market beats time in the market. It does. It generally does. And another old saying is, be greedy when others are fearful, coined by the old man Buffett, and he's absolutely right. It's easy to say, it's difficult to do, because for all of the experts out there and voices that are out there drawing a panic event, they tend to be bearish, and they tend to be calling for the end of the world, and that's normally a buying opportunity. So I'm just reiterating the same old story, which is there will be another event eventually, a big one like COVID or the GFC. Could be tomorrow, could be 5 years from now, who knows. But there will be smaller events like these ones, okay, and these tend to represent the pullbacks within an uptrend. And when the VIX breaks out like that, rather than joining in with the bearish herd, you should probably mark it on the chart and wait to see if a pivot occurs over the smaller time frames, and if that translates into a daily time frame, you should probably consider allocating sensibly, and with risk, and using all the risk management that I would normally preach, which you can find information about on the Discord in the Green Star Trading section of the Discord, and so on and so forth. So I'm not saying you just throw the kitchen sink at it. I'm just saying, I'm probably teaching Granny how to suck eggs here. Most of you guys know this stuff, but in case you're new to the channel and you're new to investing, it's often the case that people tend to follow the emotions of the herd, and they tend to get it wrong because they get easily convinced by what they're hearing on the internet. And I think we're more sensitive to that today than we've ever been, because there are so many bloody bearish voices out there all the bloody time. So anyway, there you go. VIX is suppressed down here at 15.29 at the moment, below historical levels. Since we broke out in COVID, we did set, there's this little floor here which we keep revisiting, which was price resistance. Right, I'm just going to pop this here, price support, and it's basically around 19.20 on the VIX, and we're back below 20 on the VIX and heading lower. So this is like a more localized, we'll put it in yellow, I think. What can we call it? No, we'll just put it in yellow so it sticks out. This little line here represents over this period elevated volatility. Below it represents suppressed volatility, and we'll see what happens when it happens. Alright then guys, I think that's it. That's all I've really got for you today. So primary count is bullish. We continue to make higher highs. If we break these lows, 569 spot 89, and then get a pivot in place, and we see a shift in momentum RSI, and we see candlestick patterns which support it, and a move away from the top which supports it on the smaller time frame, we can suggest that we've got a high in place. We've had them before. They could be temporary, but they could be the break of trend, so we have to pay attention. But in the meantime, that trend is still your friend. Alright then guys, if you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you fancy learning Elliott way for yourself, getting access to a large public Discord with loads of different channels on it, getting access to a bunch of other educational materials, exclusive videos each week, and a live stream, then consider joining up to the Patreon. There's a link in the description box below. We'd be glad to have you. And if you're not following me on Twitter yet, there's also a link in the description box below. And feel free to follow me. So thank you very much guys, and I'll be back with you as soon as possible. All the best. Bye bye.